Hey everybody, Chris Pulver here, and welcome back to another segment of the Pulver Report, where we trade to be profitable, not perfect. Today's installment is a really important lesson on how successful traders prepare for the ever-changing and always dynamic market conditions. Okay? On the plus side, the financial markets do the exact same things over and over again. But with all the nuances and technicals, fundamentals, and market sentiment, there are an infinite amount of possibilities on how the market moves up, down, or sideways. All right? And hopefully by this time, you know that I'd like to keep it seriously simple. And in saying that, make sure you check out my Keep It Seriously Simple video series that has a variety of timeless trading lessons. You can check that out on my YouTube page, youtube.com/ChrisPulver. Hopefully you're here doing that right now. So in the spirit of keeping it simple, the market does, in fact, go up, go down, or go sideways. All right? The financial markets can do this quickly and violently, or they can do it slowly and steadily. All right? There's a clever saying that helps explain the difference between bull markets and bear markets. Bull markets are built on hope, and bear markets are built on fear. Another nice little cliche is that bulls climb stairs and bears jump out of windows. So in other words, we might see smooth sailing markets and steady trends, or we can see extreme panic, fear, and uncertainty. This will cause circuit breakers, trade halting, all sorts of chaos. So what are we signing up for, right? As a trader, this is what we sign up for. So it is in our best interest to stay adaptive and stay current with the market conditions, right? We have to get ready for changing conditions and stay dynamic. So today's video is all about market seasonality and adjusting to trends and ranges. So let me ask you a question. Do you ever notice that sometimes trends last for a really long time? Okay? Other times we see that they're very fast, but they're very short-lived. Or how about when you mark support and resistance levels? If you have equal highs, equal lows, and the price is just bouncing back and forth for weeks, maybe even months before price actually breaks out and goes somewhere else. So we can be trend trading or we can be range trading. So let's talk about that. All right? In the stock market and in the Forex market, there are correlations. The strongest correlation as of late has been the notion of risk on versus risk off trading. All right, a prime example of this is look at your charts. Take a look at February and March of 2020 in stocks and in Forex. What you'll notice is that virtually every stock was dropping violently, okay, violently during that period. And if you look at the Forex market, you will see the risk-off currencies, the safe haven currencies, like the dollar, the yen, the Swiss franc, were really strong during that time. So when stocks are falling, dollar, yen, Swiss, safe haven currencies are extremely strong. Then, after a couple months of chaos, when the stock market and the indices bottomed, double bottoms, and this post-COVID rally ensued, stocks rallied like investors have been waiting and begging for the market to buy the dip. Okay? The COVID crash created 20 to 30 to 40+% discounts on most stocks and indices. So when the stock market bottom was in and this recovery was underway, the Forex market completely flipped and we went from risk-off trading to risk-on trading. And you notice this with currency pairs like the Aussie, the CAD, the New Zealand, the pound, all recovering against the Japanese yen, the Swiss franc, and the dollar. All right, so was this COVID crash really predictable? Okay, was the COVID crash and the rally, was it predictable? From a technical standpoint, and in my opinion, absolutely it was. All right, I was extremely bearish going into the stock market 2020. Anybody that was a part of my flex trading room knows that I was bearish on the major indices and I was very bullish on volatility. And this was December of 2019 I started talking about this. I was holding the VIXY long, which is VIXY, the VXX long, the TVIX, the UVXY. These are all instruments that are bullish when the volatility index or the VIX moves higher. In addition to that, to be bearish on stocks, I was also long on inverse ETFs. So the symbols like SH, SDS, SPXU, SPXS, these are all instruments that go up when the S&P 500 goes down. Now, did I know that the COVID crisis, the health crisis, was that going to be the reason and the why for the market to crash the way that it did? Of course not, okay? I didn't know it, and I really don't think anybody else knew that COVID would be the catalyst for the market to drop. But the sell-off, the technicals, were predictable. The positioning ahead of it was predictable. And if you were positioned, the payoff was incredible, right? The volatility index in the VIX rallied 600% in 2 months. That translated to 460% in the VIXY, 500% in the VXX, and 2,400 and 1,000% on those triple leverage instruments, the TVIX and UVXY. Ridiculous and staggering numbers. And although I was positioned ahead of it when it was all happening, I was already in these trades and just doing my best to let my profits run with trailing stop losses. All right, it was a wild and crazy and chaotic couple of months, but it was incredibly profitable, provided, of course, you found yourself on the right side of that move. How about these inverse ETFs? The one I played were single, double, and triple leveraged. So as the S&P 500 was dropping, which it dropped about 35%, these rallied respectively 35, 70, and 105% depending on that leverage. So all I'm saying is look at the charts and you'll see exactly what I mean. So look at the stock market, look at the S&P 500, look at some of those inverse ETFs, look at volatility, look at Forex pairs, and you'll see the correlations during that time. Now, that is an extreme example. That is an anomaly and an outlier, but it's a great lesson to see what happens. Now, that was a concentrated window. We had all this chaos within 2 to 3 months, but sometimes it takes years for the same type of cycles to play out. So let's bring it back to current market conditions, and can we get ready? How do we get ready for changing conditions that aren't outliers, that aren't anomalies? How about just regular market seasonality, like trending season versus range season? All right, there's an interesting statistic for Forex trading. The market trends about 30% of the time and ranges about 70% of the time. And some would even argue that it's range bound 80% of the time and trending 20%. Now that completely depends on the time frames and the lens of the trader. If you're a day trader trading 1-minute charts, you can see trends every single day at some point during normal active trading hours. If you're a swing trader or a position trader, you know that it takes time to build positions, and it takes time to see these market ebbs and flows play out. As a trader, there is very little that we can do, or in fact, there's nothing we can do to control how long it takes for a trade to work. Okay, I've sat in trades for minutes, hours, days, weeks, even months, and it's completely dependent on the setup. If it's a long-term trade and it's a position trade, I know that I need to be patient. All right, if it's a swing trade, maybe it's a week, maybe it's a couple of weeks, but as long as the trade stays valid, I stay in the trade until my profit destination is hit. So just like everybody else, when I press that buy button, I want it to go straight to my profit target, okay? When I click that sell button, of course I want price to drop straight down and go straight to my profit target. But trading isn't like this, okay? There's risk, there's reward, and we have to trade probabilities. So if you want to know the most important elements of consistently profitable trading, check out my lesson that I just posted not too long ago on equity management. In my 20 plus years of trading, okay, I'm going to give you my best practice for Forex trading when it comes to market seasonality. So here's my breakdown. December and January, it's the end of the year and beginning of the year trending environment. We might see some tops and bottoms in October, but from Thanksgiving onwards, holiday trading, typically November, December, the Forex markets are trending. All right, pause for a little bit, then go into April and May. This is a pre-summer push. This to me is one of the most aggressive trending environments. All right, these pushes can be so aggressive that they can push oftentimes through May and continue to drift into June and July. And we really don't see them stop or cease or top or bottom until August, which is a transition month. If I'm seeing trends going into August, then I'm going to start looking for tops and bottoms to form and transition into another cycle. So trends will end, tops and bottoms will form. Maybe we have trend to trend, but we're changing directions. Maybe we go from ranges to breakouts. But August is a really important and consistent transition month. So be ready for things to change. Then moving along through the calendar, September and October is a post-summer breakout where I'm looking for trends. Okay, school's back in session. Vacations are wrapping up or done. It's back to the rat race, it's back to the grind, it's back to the office and the trading desks. So how important is it to know this stuff? Let me ask you this. If you like trend trading, would it be helpful to know when the trends are more likely to occur? Or do you love forcing trend trades when the market is going nowhere, right? We don't want to trade trends in ranges. We don't want to trade ranges when it's trending. So I think you know the answer. Okay? Let's trade trends when the market is trending. Let's trade ranges when the market is stuck in consolidation. So that's my Forex summary. We have trending months pretty much end of November into December and January, April and May for pre-summer push, September, October for the post-summer breakout, and ranging in between. Just depends on how you look at it. We have to stay dynamic. We have to adjust our strategies to accommodate trending and ranging currency pairs. Okay? So let's talk about stocks. According to the Stock Traders Almanac, September is the month historically where all three US indices perform the poorest. Okay? September is called the September effect. And as I'm doing this video right now, and based on the phrase bulls climb stairs and bears jump out of windows, what do you think this means for volatility in risk on versus risk off trading if the stock markets are performing poorly? Go ahead. I'll wait. I'll wait for your answer. Risk off trading and higher volatility are the byproducts of a poorly performing stock market. So if stocks are dropping, volatility is up. If stocks are dropping, risk off trading is the tone. Okay? And this is why even after a steady rally from 2020 post-COVID into 2021, I'm looking for a Q3 correction. It might be a cleanse, might be a correction. It might posture a move that sets us up for a top after one of the greatest 11 to 12 year rallies that I've ever participated in, but time will tell. But here's what's important to remember. The technicals tell the story. The technicals provide the clues. The fundamental fuel, the why, the catalyst, you'll see it in the headlines. There's going to be something that explains why the market's doing what it is, right? If you're looking for gossip at the water cooler, if you're looking for the scuttlebutt, you'll find it in the headlines. But the technicals with the fundamental fuel, the catalyst, become self-fulfilling. All right, so here are some more interesting statistics and facts about stocks month to month. And I'm going to use this from the S&P 500 from 1950 to 2020. All right, so a positive month means that the month finished positive, and a negative month means the month finished negative. And of course, we'll start with January. January, 42 years up, 28 years down for an average return of 0.98%. February, one of the shortest trading months in the year, 40 years up, 30 years down, average return, goose egg, 0% on average. March, 44 years up, 26 years down, average return, 1.06%. April, 49 years up, 21 years down, average return 1.36%. Month of May, 41 years up, 29 years down, average return 0.09%. June, 36 years up, 34 years down, average 0.03. July, 40 up, 30 down, average return 0.93%. Not too shabby, July. August, 38 years up, 32 years down, average return negative 0.26%. The first negative monthly average for this 70-year history. September, you remember me saying the September effect? 32 years up, 38 years down, average return for the month negative 0.7%. The worst performing monthly average for the S&P 500. October, 43 years up, 27 years down, average return positive 0.68%. November, 47 years up, 23 years down, average return 1.42%. And December, 52 years up, 18 years down, average return 1.37%. So let's break that all down. April, November, December are historically the most bullish times in the S&P 500. August and September are the most bearish averages for the index and stocks. Now, this is historically the evidence of the phrase, sell in May, go away, because most of the bullish movement historically over 70 years comes from October to April. So throwing out these facts, what does this all mean? Okay, it means this. If you have data, if you have historical evidence to make sound decisions with what the markets do more often than not. That's called a probability. And in trading, a probability that is in our favor is worth considering and setting up positive reward to risk trades. All right? We play the game, we trade by numbers, and we keep trading. So would it help to trade trends and ranges at the appropriate times? Would it help to stay bullish or bearish during the historically accurate times? Of course. And for me, I have my experience and my systems to help me do exactly that. Okay? One system in particular that I've shared in my Pulver Report is my perfect storm. And since 2019, the perfect storm has been one of my most consistent trading systems for Forex. This system has allowed me to capture profits not only in ranging conditions, but also in trending markets. All right? If you want to see more on the Perfect Storm Pro, you can check out my testing and optimizing robots video. Again, check it out on my YouTube channel. You will see 3 years of testing and live trading on that system, and it's a freaking beast. Okay, I love that Perfect Storm. It is one of my favorite systems and my little buddy when it comes to automated trading, right? So there you have it, okay? The market trends, the market ranges, we know that. It varies from month to month, but now you have enough information to arm you with the probabilities to trade trending windows, ranging windows, bull markets, and bear markets, all right? Just understand that there are outliers, there are anomalies, there are no guarantees, all right? Nothing is perfect, but with historical evidence on your side and thousands upon thousands of trades in stocks, Forex, everything you can review, we all have a fighting chance. The financial markets are enormous. They are huge. And they don't care how much money we make. They don't care how much money we lose. What matters is that we keep surviving and trading, all right? So keep taking great trades. Keep trading great probabilities. And we will be seeing it, protecting it, and collecting it month after month and year after year. All right, so that'll do it for me. As always, thank you for watching the Pulver Report. And if you would take one very helpful second and click that thumbs up button, like this video, that helps me, that helps this channel a ton. Okay, you poke that YouTube algorithm, you will help me spread this video to others that are looking for trading education and great content. I really mean it. It's 1 second. The thumbs up button and your comments help me so much. So for today's magic phrase, type this in: bulls and bears. Bulls and bears in the comment section. So in the description of this video, I'll also include helpful links from the images I showed today throughout the video. So check those out, take a closer look at them. And if you would like to subscribe to my free Pulver Report newsletter, I'll include that link in the description area as well. Alrighty, let's wrap this up. Happy trading and lots of profits, everybody. See you soon. Chris Pulver, over and out. Thanks, bye.